I'm going to focus, first of all, on the banking sector in Europe. You may have read from the financial press, particularly the Financial Times, that the banking crisis is far from over. We currently have a mountain of non-performing loans, which is estimated to be close to $1 trillion. That's quite a substantial figure. The Italian banking crisis has, of course, made the headlines. What we should be focusing on, and the focus of this report, is to examine why this banking crisis arose, what errors were made by the European Commission and the ECB, along with the bankers themselves, and then to ask what should we be doing to correct this matter. In the report, on page 5, I outline some of the questions that we attempt to address in this report. First of all, did the ECB play a part in helping banks to conceal losses so that it could discreetly subsidise the banking system, which in turn found its way to banking bonuses? I believe the answer to that question is yes. The reason for this is that in 2001, the ECB became aware of attempts by members of the accounting profession to introduce loopholes that allowed banks to conceal or delay the recognition of losses. These loopholes were contained in an accounting standard called IAS 39. It was a loophole that apparently allowed banks to make misleading statements as to their financial position. In summary, some banks from the period 2005 to the present were deeply insolvent, but they never revealed that in their annual report because of this loophole. The same banks, particularly banks in Ireland like Anglo-Irish Bank, claimed that as late as 2008 and 2009 they were making substantial profits. Yet they had to avail of substantial funding from the ECB, and they later admitted to substantial losses that they made. Secondly, did the ECB break the law by helping banks to conceal their true financial position? Again, I believe they did. IAS Regulation 1606 of 2002 basically says that you can only apply accounting standards that comply with company law. And as you probably are aware, a bank or company is not allowed to trade while insolvent. There is the risk that banks following the accounting standards or the loopholes in the accounting standards were able to trade while insolvent because they failed to reveal their financial position correctly. The result had a huge impact in places like Ireland, where the government had to inject €64 billion into the banking sector. As you are probably aware, Ireland had to borrow money from the ECB and the IMF in order to bail out its banking system. The question is, should Ireland return that money? The obvious answer might seem yes. However, the Irish government bailed out the banks on the presumption that the banks were solvent. And therefore, this is similar to a flawed insurance contract. If the Irish banking system, or rather if the Irish government agreed to bail out the banks when they were solvent, it follows that their loss exposure was quite limited. In reality, many of the banks were insolvent, they had huge debts, and therefore the Irish government ended up taking on responsibility for those debts, though technically it didn't agree to do so. Therefore, there is a question mark as to whether the Irish government should repay or indeed has the legal capacity to repay the funds that it borrowed from the ECB. There are several other questions which we address in the report. First of all, were bank shareholders misled? In my view, the bank shareholders were misled. If you produce an annual report which misstates your financial position because you failed to reveal all losses, then you should not be raising money from shareholders, and neither should you borrow money. The Irish shareholders were misled because all Irish banks, particularly those who were bailed out, showed substantial profits, and they often looked for rights issue, or rather initiated rights issues. That means raised money from shareholders at a time when they did not reveal their true financial position. There are some other issues that create problems. First of all, who owns the collateral of the Irish banks? This is a technical area, but I won't get into it in too much detail. But in essence, if an Irish bank sells an asset while it's insolvent, there is a legal question because it may not be the true owner of those assets. In the case of Ireland, many of the banks sold assets to what was known as a bad bank, called the National Asset Management Agency. There is the question whether the Irish banks had the legal standing to sell those assets to the bad bank, on the grounds that the banks were potentially insolvent when they sold the assets. As you probably are aware from company law, banks are generally not allowed to trade while insolvent. And certainly they should not disguise the fact that they're insolvent when they're selling assets. Some banks have raised money through the issue of a prospectus. It's difficult to see how those banks were complying with the law because they used information that was contained in annual reports. And if the annual reports are not portraying the true financial position correctly, there are potential problems. The European Central Bank has an important role to play in the banking sector. In essence, they do provide funding for banks called liquidity funding or Target 2 funding. The question is the ECB allowed to lend money to banks that are insolvent? And the answer has to be no. When the ECB lends money or makes liquidity available to the commercial banks, it's on the understanding that the commercial banks have the ability to repay those loans. There is certainly a question mark over many Irish and UK banks who exploded or became insolvent. When they drew funds down from the ECB and the Bank of England, they may not have had at the time the capacity to repay those loans. There are a number of consequences arising from this loophole or this flawed accounting standard IAS 39. First of all, share support. Many banks lent money to investors to buy shares in their own banks. And these loans were made on a non-recourse basis, which basically means that if the shares fell in price, the banks would take the loss and not the investors. These share support schemes are illegal, but are potentially possible under accounting standard IAS 39. And because they're illegal, there is a problem. We've had court cases in Ireland where these share support schemes were examined. The second issue is insider trading. Insider trading is where you buy or sell shares with knowledge that's not available to the general market. In Ireland, many investors who invested in the various banks were professional investors. They had access to the bank's books and were able to do what's known as due diligence. That means examine the books in detail to ensure that the banks were able to repay their funds. If the bank is producing an annual report which is misleading and professional investors have access to the books, then there is different pieces of information. The investors who have access to the books through due diligence are able to see how much trouble the bank is in, whereas outside investors are unable to see what's going on because the annual report does not reveal the true financial position. So if the true financial position is not made available to everyone, we have potential problems with insider trading. There are other issues in Ireland which we discuss in the report. For instance, some loans were made on preferential terms to influential investors or influential businessmen. When these loans are made on preferential terms, they are effectively subsidised loans, but the subsidy was concealed because of flaws in the accounting standards. This chapter focuses on the concept of prudence. Prudence basically means that you cannot hide losses. You must never overvalue assets. And it's the cornerstone of IAS Regulation 1606/2002. Basically, when you are portraying the financial position of a bank in its annual report, you must make sure that that is portrayed accurately, and you must avoid instances of overvaluing assets. You have an International Accounting Standards Board, which is partly private, partly funded by banks, partly funded by the big four accountancy firms, and partly funded by the European Union. In fact, I believe that the European Union has recently promised 43 million funding for the International Accounting Standards Board over the next couple of years. This organisation was set up to ensure that banks were behaving consistently and that they had consistent accounting standards and that those accounting standards complied with the relevant laws. They were given a remit to produce accounting standards that complied with IAS Regulation 1606/2002. It meant that for their standards to be adopted here in Europe, they must adopt the prudence concept. In other words, they cannot write accounting standards which delay the recognition of losses. Unfortunately, the architects behind the International Accounting Standards Board have decided that prudence no longer has a role to play in accounting, and they devised accounting standards which allowed banks to delay the recognition of losses, or at least that's what they claim to have done. In reality, it is a legal issue. They were not given the authority to change company law rules in that way. As you may be aware from company law, banks must never trade while insolvent or raise money while insolvent, because it is a fraud on either the shareholders or the people who lend money to them. And therefore, the accounting standards cannot encourage or allow people to delay the recognition of losses. This error has been going on since at least 2005 and perhaps earlier. It came to light in a number of UK banking inquiries in 2010. The International Accounting Standards Board promised to correct it, and they introduced a new accounting standard to replace the existing accounting standard. That new accounting standard is called International Financial Reporting Standard number 9. And they gave a reassurance that banks would recognise losses that they hadn't done before. However, if you read through that International Financial Reporting Standard, there are a number of loopholes which once again allow banks to delay the recognition of losses. So it remains a very serious problem today. So if you think about it, this is quite a serious problem. Here there is a problem, because what the IASB, the International Accounting Standards Board, have done publicly is quite different to what they have done privately. In public, the then head of the International Accounting Standards Board, David Tweedy, said, "No entity is ever allowed to disclose assets valued at more than their recoverable amount in its financial statements." That basically means that when you are producing an annual report, you cannot overstate the value of those assets. However, a second person on the IASB committee, somebody called Sue Lloyd, said something quite the opposite. She didn't state this as publicly as David Tweedy, but she did say that under IAS 39, potential credit losses remain hidden until signs of deterioration are evident. So you have one person in the committee saying, reassuring investors that banks may never hide losses. And you have a second person on the committee, on the same committee, saying that banks are, it's possible to delay the recognition of losses under the same accounting standard. Now that is a huge error, and it's probably a good example of complete failure of the International Accounting Standards Board. If it says something in public to reassure investors, and then privately tells people who are preparing accounts that they can do something different, it is a major problem. Various inquiries have taken place over the last couple of years to try and unearth this scandal. The International Accounting Standards Board was subjected to severe criticism from two House of Lords committees where they examined what caused the banking crisis. In essence, the IASB were accused of dropping prudence. This is the company law requirement that banks disclose all their losses so that they can reveal their financial position correctly. In Ireland, about 3 years ago, we had a banking inquiry, and the issue of IAS 39 and the International Financial Reporting Standards came up on numerous occasions. One important piece of evidence from that inquiry was given by the former Central Bank Governor Patrick Honohan. He repeatedly criticised the International Accounting Standards Board for developing accounting standards that allowed banks to overstate the value of their assets and delay the recognition of losses. And he went further. He claimed he had a legal opinion confirming that the Irish Central Bank could not challenge those banks who hid their losses by under-providing for assets. We have asked for details of this legal opinion, but the Irish Central Bank have said that they will not give it. And it's very difficult to believe that somebody would write a legal opinion confirming that banks are allowed to hide losses. There was a debate in the UK following the financial crisis where legal experts examined whether the accounting standards complied with company law if they allowed banks to hide losses. It started with a legal opinion from a guy called Martin Moore QC, who claimed that the International Financial Reporting Standards comply with company law, they comply with the IAS regulation. However, he didn't make clear in his legal opinion whether the International Financial Reporting Standards allowed banks to hide losses. As I said, there are two different versions of the IASB given by the IASB themselves. Under one version by David Tweedy, banks must reveal all losses. If that version is correct, it follows that the International Accounting Standards generally comply with company law. However, a second definition by the same committee, by another committee member, Sue Lloyd, claimed that banks were allowed to delay the recognition of losses. Now, if that's the case, there is a huge question as to whether Martin Moore was correct in stating that that following the International Financial Reporting Standards automatically comply with company law. When Martin Moore issued his opinion, a second opinion was issued by George Bompas QC, and he drew the conclusion that banks which dropped the concept of prudence and delayed the recognition of losses were not in compliance with company law. And he even suggested that banks who do delay the recognition of losses may be acting in a criminal manner. In Ireland, the Institute of Chartered Accountants have argued that you can hide losses under the accounting standards and that it is legal. It issued a report stating, CARB, that's the Chartered Accountants Regulatory Board, believe it unfortunate that compliance with an accounting standard is deemed of itself to result in a true and fair view of a company's financial position. Accordingly, CARB believes that in the future, the first principle that should apply is true and fair, followed then by adherence to the individual standards. Now, George Bompas would believe that that statement is incorrect, because if you are giving a true and fair view of the bank's financial position, you must reveal all losses. So there is a potential cover-up which needs to be examined. So we have a very serious issue. It's not going to be resolved in the short term. We have been told that a new accounting standard called IFRS 9 will resolve the matter, but if you look at the standard, there are still opportunities to hide losses under the revised rules, and if those rules do exist, then banks will continue to hide losses. So just to summarise, we have a major problem with banks in Europe. Non-performing loans are getting close to €1 trillion. I said $1 trillion before, but I meant €1 trillion. This is a substantial problem. Currently, the Italian banks have hit the headlines because of this issue. The problem arises for a number of reasons, but the main one, in my opinion, is that banks were able to disguise their financial positions. This offered two advantages. First of all, banks could pay themselves a huge bonus based on artificial profits, and therefore they kept going and lending recklessly, knowing that they could record profits on transactions which were loss-making. Secondly, by concealing their true financial position, banks are able to avail of ECB funding, which is a form of subsidy and a substantial subsidy. And that subsidy is recognised as profits in the annual report, and therefore it is released into bonuses. So the matter does, in my view, require immediate attention. Here at the European Union, you have the authority to do so. You can remind the International Accounting Standards Board that if they require funding, they must make it clear whether they are allowing banks to conceal losses or not, and whether those rules are in compliance with IAS Regulation 1606 of 2002. If we don't address this problem, there will be a number of knock-on problems, apart from the obvious ones. We will have illegal share support schemes. We will have insider trading. We will have banks entering into illegal contracts. We will have banks issuing false prospectuses. We will have banks making preferential loans to influential customers. And we will have banks tempted to conceal their position by concealing how much interest they pay on their borrowings. So that's all I have to say. If you'd like to ask questions, please feel free to do so. And once again, I would like to thank the GUE NGL Committee for allowing me to present this to you, and also to thank Luke Flanagan, who commissioned this report. So thank you.